Guys, I'm going to show you some stocks I'm buying this week. We're going to go through Stock Analyzer tool to determine why I'm buying at this price. And then I'm going to show you how I use cash secured puts to buy these companies to get paid while I wait for the companies to fall to the price I want them at. So first off, what is a cash secured put? Okay, so a put, when I sell a put to somebody, what I'm doing is I'm selling them the right to have me buy the shares or me buy the shares from them at a certain price in the future. Now, one big caveat, if you're new to the channel, even if you're not new, this is a harder concept to understand, but it's extremely valuable in generating excess cash on your accounts while you wait for stocks to fall the price you want to. Remember, I always sit there and say, you have to use the fundamentals to buy a company and use the emotions to keep the company and let it compound. And one of the most common emotions I see from investors out there is, I want to buy something. Well, selling cash secured puts allows you to stay active, so you're not always just scrambling to buy something at all times. So basically it says, for example, my first company is Ulta Beauty. So let's look at Ulta Beauty and I'll get into the whole cash secured puts. It's had a big fall as of late. It's at 405. In the year to date, it's down 17%. In the last 1 year, it's down 24%. In the last 3 months, it's down 20%. In the last 1 month, that same 23%. So this is a company that's fallen a lot. Ulta does a great job of making smart growth decisions in new stores, and they grow their same store sales very consistently. So I love that about Ulta Beauty, and I think they're good allocators of capital. So let's go see what price we want Ulta Beauty at based on our stock analyzer tool in the past. I recently did it, made some very reasonable assumptions on growth, on profit margin, on the future PE, and my desired return. And I hit the analyze button, and I get a price here of around 310. But remember, it's at 310 for a 14% return. I don't necessarily need a 14% return to be happy about Ulta. Let's go to a 12% return. And there's my price right there, 356. It's on my watch list at 350. So what I'm going to do is this. We're at 406 right now. That's kind of a big drop to go from 406 to 356. But let me show you what I'm doing. I pull up Ulta Beauty options chain, okay? And I'm going to sit here and pick out, let's say, 32 days from now. So this is the options chain. On the right side here are puts. So it allows me, if I sell somebody this option, they can put the shares in my hand at that price. So we said it was roughly 355 to 360. So I'm going 32 days from now, May 31st, okay? And I'm looking at the 360 strike price. Guys, the current bid and ask is $3 to $4. So let's call it $3.5 in the middle. So what that means is I can charge somebody $3.50. If on May 31st, 2024, 32 days from now, that stock falls below 360, they can force me to buy the shares at 360, okay? Now, I would get the shares at 360 minus the $3.50 I collect from them. So essentially I'm paying $356.50. Not bad. Now, what happens if the stock falls to 340? I have to buy them for 360 less my 350. So I'm still buying them for 360, 356.50. So it's very important you understand that when you sell a put at this price, you're basically saying, I don't care what happens. I am buying it for this price and I'm happy with that. That's so important because the biggest mistake emotionally that I see people making is the stock falls further. They're like, damn, I wish I'd bought it. I wish I'd waited and not sold that put. Because the plus side is, if it never hits, if it's on May 31st and it's at 380, you keep your 350, you don't get the shares because the stock is above that price. So it's extremely, I cannot stress this enough, guys. It's extremely important that whenever you write a put, you are happy getting the stock at that price. You're essentially saying, if that stock was 360 today, I'm buying it. So I'm willing to go take the risk of it falling below there, but I'm going to get paid for that. That is the big key. So what's my return on this? Why do I do this? Well, guys, you just saw. Let's do the math here real quick. We got $3.50 and our strike price was 360. So essentially this is about 1% for 32 days. Guys, that's roughly 12% per year. So if I did this over and over and I never got the shares, my cash would generate me 12% per year waiting. That's the big key. Because what's the current 90-day treasury if you annualize it? It's about 5.3 to 5.4%. I'm getting over double the return on my cash. And even better, if it falls below 360, I get shares of a company that I love at the price that I was willing to wait for, and I got paid to do that. Because essentially, if it falls to 360, I only paid 356.50. So I even get a 1% discount on my stock. Again, what are the risks? The first risk is it falls below 360, drastically below, and you're like, damn, I wish I'd gotten it. Because look, a month ago, Ulta was $500 and some a share. Now it's $405. That is a risk. But if you understand that when you buy a stock, you're buying a piece of a business, you should root for the stock to fall. You should want that to happen. Because guess what? Let's say it falls to 340 and you get some shares. You can then write more puts at an even lower price. Let's say 310. Now you're dollar cost averaging all the way down and getting paid to dollar cost average. That's what's incredible. That's what I love about selling cash secured puts. I get a really high return on my cash while I'm waiting for the stock to fall to where I want it to go. Now, you might sit there and say, well, Paul, what if I want to go with a lower price, but further out in the future? I love that idea. Let's go back to our options chain. And instead of going 32 days out, let's go 144 days out, September 20th. But in this situation, you want a really cheap price. So at $300 a share, the current premium is $330 to $350, so about $3.4 per $3.40. But guys, the difference now is it's 144 days away. So you got about the same premium. You got a much lower price, $300 versus $360. But what's your return now? Well, let's go back to the page and do the math here. You're getting $3.4 on a $300 strike price. That's about 1.1%. So remember, you're getting 1% over 30 days before. So you're getting 1.1% on 144 days. So roughly how many times 144 going to 365? Let's say 2.5 times. So your cash return is 2.5 times here. You're at 2.7%. Well, that's pretty crappy. 2.7% annualized. You can sit in cash and get 5.3 or 5.4 over the year. So in this situation, I'd just sit there and just wait for the stock to fall. There's no reason to sell a cash secured put if your cash return isn't pretty high. In fact, I believe you should be getting probably double what you can get in cash. I think 10% or more is what you need to get to be able to really justify it. So this is about balancing the right price with the right term of time. That's what's really important here. Now, you got a much lower strike price here. So maybe you're like, hey, but I still sit there and say, but you can put it in cash and just wait and get 5.3%, double this return. But remember, the big key here is the emotional side for several reasons. First off, if you're selling cash secured puts, you're already probably sitting there saying you're already pretty good emotionally saying, I love companies at lower prices. But it still is all about that when the stock does fall below that strike price, you can't have FOMO sitting there saying, damn, I want it even cheaper. That's what's hard about investing. Because all along the way, you sit there and you see a company fall. And when you don't own the company, you're excited. You're like, go, go, go. But the second you own the company or have cash secured puts at a lower price, you kind of have a little FOMO creeping up. I get the same thing, guys. I have it happen to me all the time. What do I do to change that? I take myself out of the situation. I don't even look at them after I've written them. The chips fall where they fall. The last time we did this video, I did Intel puts at 35. Intel's below 35 now. Don't think for 1 second I didn't think to myself, crap, I wish I'd gotten that. I wish I'd been more patient and waited for that. Because I'm still satisfied buying Intel at $35, subtracting out then the premium I got. And that's what makes investing hard, is that emotional aspect. I used to think investing was 90% fundamentals, 10% emotion. It's flipped. It's 90% emotion, 10% fundamentals. And that's why we created this channel and this software and community. The software is there to help you make the fundamental decisions, but the way you're going to make a lot of wealth is having the emotional fortitude to wait out the rise and falls of stocks. That's what makes it hard. And that's why this community of like-minded investors is so important, to be able to be around people that think like you so that you're not home alone watching stocks fall and getting scared. That you can sit there and talk to people about these emotions and help each other out. I see it all the time in the community. I see it all the time for me. Sitting there and saying, okay, what's going on with this company? Is it really truly what's going on? Remember, news follows the stock price. Look at Ulta. If you go back 1 month, this stock has just fallen. Boo! 20-some percent. It was over $530 a share just 1 month ago, and now it's in the low 400s. That's what can happen. And it's important that you stick to the fundamentals because the news will follow. Now the news will start being, if Ulta goes to 300, you know how bad the news on Ulta is going to be? It's not going to be people saying, this is a great company. It's going to be the opposite. So if you want to have a better hold on your emotions and be able to make more money in the long run, click the link below, join our community, $7 for 7 days. And guys, sign up now because we now have a wait list in check. We only allow a certain number of people every single day. So make sure you click that now because the wait list is in full force right now. Company number 2, Southwest Airlines. Guys, this company has been beaten up like crazy. And if you watch some of our past videos, I explained to you my thesis on Southwest, and it's very simple. I'll go through it right here. They've got problems. Their profit margin in the last year, 1.5%. In the last 5 years is 0.6. You go before COVID, their profit margin was 10 to 15%. That's my thesis, that they're running through a short-term problem, but this is a very well-run airline. Could it actually work out poorly for me? Absolutely. But guess what, guys? The first time I bought Southwest was in the middle of COVID. You know what I paid? $25. Look at where it's at now. $26.50. So I'm looking at it going, okay, they have record revenue. They've had some issues lately. They have the Boeing problems. Is it a perception problem? Maybe. But I truly believe that Southwest is the best run airline. So this will be a fun one because here's why. Let's go pull up Southwest in our stock analyzer tool. And it's even more fun to sell puts when the price is well below your strike prices. So right now I could buy Southwest. So maybe I do something really tricky here. Southwest at $26.50. Let's go look at the options right now for Southwest. Let's go out 11 days. If I want to buy Southwest today at $26.50, for 11 days from now, somebody's going to pay me 55 cents. For 11 days from now. What kind of return is that? Well, let's go into our little trusty page and go 55 cents divided by $26.50 is roughly 1% is 26.5. So it's roughly 2% return for 11 days. How many 11-day periods are there in a full year? What is that? 300? Let's call it 33. Nope, 34 of them. So 34 times 2%, I'm getting a 68% annualized return on my cash at today's strike price of $26.50. So if it ends at today's price or higher, 11 days from now, I keep my 55 cents and I make my 2% over the next 11 days. If it goes lower, I get the stock at $26.50 less my 55 cents that I received in premium here. So I get it for roughly $26. I still get a discount today. Now, another risk I want to explain to you is you sell the put, the stock goes up from there, you never own the stock. The whole purpose, the whole point is to buy the stock. So what I recommend people do sometimes, especially if it's in a situation like this where I like the stock at current price, I would probably buy half of the shares I wanted to straight up in the market, and the other half I'd sell puts on because I love this premium. I love this premium. It generates income on my cash far in excess of what I can get from a 90-day treasury. So why not? That's what I love doing about it. Now remember, you have to want the stock at this price. That's the emotional side that's so difficult for a company like Southwest that has glaring problems out there. But I truly believe that their mean reversion on their profit margin will take us to where they need to be. Because remember, I sat here, even on the low side, I only put 8% profit margin here. They were doing 10 to 15% below. So even on the low side, I see a lot of upside potential here for the stock. I just think it's been grossly exaggerated because of the current problems. T Rowe Price. Now, T Rowe Price has been up and down company for quite a while. The all-time high, August 30th, 2021 of $225, had a 52-week low back in October of $87. So over the last 5 years, it's only up 5.7% from 5 years ago to now. That's incredible. Now, T Rowe Price is definitely a company that if the market goes down significantly, this company will be hit hard. But again, we pull up our stock analyzer tool, pull up T Rowe. We just did it back on April 1st, a market return of 9%. So we have the value here on earnings and pretty close on free cash flow. So I'm looking at this saying, guys, on my middle assumptions, I'm going to pay a lot higher than it is today. So Maybe it's on my watch list for $100. Let's go see what the options look like for T Rowe at $100 strike price. Let's pick June 21st, 153 days from now. Okay, so 53 days from now, $100 per share is between 55 and 75 cents. So let's call it 65 cents, right in the middle. Okay, let's go back and do our easy math here. So Uncle Paul's here to do the math for you. 65 cents at $100 strike price equals 0.65% or at 53 days. Well, how many times do we do 53 days in a year? It is roughly 7 times. So 7 times 0.65 is 4.55%. So guys, it's below the 90-day treasury. I'll just buy the 90-day treasury. No reason to go sell that put. Why go sell that put to get a lower return on my cash? Because remember, the bank isn't going to give me this return when I put the cash there to secure those puts. They're not going to give me my cash return. So it doesn't make sense for me on T Rowe. Now, let's say I wanted T Rowe at today's price, which according to this, I might want it at today's price. Because look at this return. I have the lowest price here in the middle of 150 without any margin of safety. So is 113 an adequate margin of safety? It might be. So let's go back and look at our options. 18 days from now at the current strike price. It's roughly, let's go with 115 here. A little bit higher. It's paying $3 per share. $3 per share. That's 2.5% over 18 days. Now that's a pretty good return. Now again, do you want it for 115 less that $3? So $112. Yeah, you might want that. And if you do want that, that's a great return. For 18 days, you can get 2.5%. What's that annually? How many times 18 go into 365? 20 times 2.5% equals 50% overall cash return. If you get to do it over and over and over again at these metrics and never get assigned the shares. That's a great way to create cash for yourself while you wait there patiently for the companies you want. So guys, you're here watching this video because you want to get stocks to buy. Watch last week's video we just did. It's going to pop up next on 5 stocks to buy with huge potential returns.